the stock market is down. Now, if you are feeling lost and uncertain what to do next, in this video, I will share with you the mental model that has helped me to navigate whenever this happens and what are some of the things that you can do to help your portfolio. Hi everyone, my name is Yuan Cheng. I'm an investment coach, and over the years, these are some of the important lessons that have helped me whenever the stock market is down. Now, I want you to imagine that today you are a business owner, you have put your hard-earned capital into opening this store. Now, this store sells some of the world's best sneakers, and your passion is to run the stores to sell as many as you can. Now, imagine this sneaker store grow 10% every year for the next 10 years, and you started making 100,000 in the first year of doing business. Here's how your income will look like over time. On the first year, 100,000 compound by 10% each year. Now, over 10 years, the total accumulated income that you are brought in is about 1.59 million. But you must know that in the real business world, there will be good times and bad times. Imagine now there's another COVID-like event that happens. Your business is forced to shut down over the next 3 years. And if you recall, during the pandemic, the stock market dropped tremendously. There were tons of negative news floating around the news and the social media. The more the fear escalates, the more the stock market starts to decline. And back then, S&P 500 sees the fastest correction in history. Now, during that period of time, a lot of investors were lost because facing a pandemic fear has been a long time since history, and this can be seen as a new experience for some of the investors. A lot of investors were panicking. A lot of people sold their investments, keep into cash, hoping to get out of the market as fast as they can. Let's assume originally you are expected to earn around 1.59 million. Because of this COVID-like event, you lost the first 3 years of your income, which turned out to be 331,000. Now, 331,000 consists of the first 3 years' income combined. It will reduce your earnings from 1.59 million to 1.26 million. And this lowers the income by about 20%. But what happens in the stock market? Back then, when pandemic happens in 2020, as you can see from this chart, the S&P drops about 35% during that period as the short-term fear accelerates. Now, the question is, your business income declined by 20% and the stock market declined by 35%. Now, imagine back then, this sneaker store is Nike. And if Nike stock price were to drop more than 20%, does it make sense? And obviously, this is known as price distortion. So if you can recognize this distortion, it becomes a golden opportunity to buy. But is it that straightforward? If it's so easy, everyone would have done it. The problem is, why did investors get paralyzed by the bad news? Number one, they invest with money that they have borrowed or money that they do not have. Number two, they're uncertain about the stocks in their portfolio. They can't tell whether the quality is good or bad. Number three, they put a bigger sum of money concentrated in one or two companies in the portfolio. So if you are caught in any of these situations, always remember, recognize that the market is down, don't panic, sell. And here are the 3 steps that you can take. Number one, understand the market downturn from looking back at the history, what happens during a market downturn. Number two, focus and research on the company's financial health. Number three, what are some of the traits that we look at focusing on the long-term business performance. And now it's not new that stock market will drop, prices will decline, but how does it look like from a historical perspective? And this is some bear market that happened in the past. And over time, and as an investor, if you invest in the stock market, you must accept that there will be a bear market in the near future. Now in this chart here, we can see that most of the market crash a minimum of near 20%. And the largest crash we had back in 2007 is about 56%. How long does the bear market last? Now if you look at the middle column, the shortest bear market is about a month, and the longest itself is about 31 months. If you look at the recovery, we have as short as about 3 months, and the longest duration is about 69 months. So that shows us that it is very difficult to predict how long the market will drop and how fast the market will recover. And therefore, it rewards investors to take opportunity when the market starts to decline, because the recovery can be as short as 3 months. Number two, focus on the financial health. Now, why do we have to focus on the financial health first? During recession, a lot of businesses will shrink their budget a lot of company might close down, and during a bad economic downturn, a lot of company might downsize and shrink their budget. A company that may be earning money during normal economic environment may not be able to do so and pay the debts during that period of time. So when we look at the financial health, these are the 3 questions that we ask. Number 1, does the company have liquid cash to pay at least 3 years of its obligation? You can look at the cash ratio, the quick ratio, and the current ratio to see if the company has the ability to pay over the next 3 years. Number 2, can a company pay interest on its debt for the next 3 to 5 years? And you can also look at the size of the debt, where we look at the debt over equity. You can look at the size of the debt by using the debt to equity to see how big the debt is. And of course, if you have access to look at the current and quick ratio, you'll be able to task whether can the company pay the interest itself. Number 3, can the company liquidate its asset to pay its debt easily? Now let's take a look at this example. Now you remember that if you are the sneaker store owner, you own the factory, you own the inventory of the shoes. Between the shoes and between the factory, which one is easier for you to liquidate when you need to pay your debtors? Now obviously the inventory will be sold easily at a discount, but the factory will probably take a longer time due to the investment size. So if you understand the ratios itself, this will prevent you from investing or holding stocks that has high debt or is unable to pay off or sell off its asset during this period of time. Number 3, focus on the long-term business performance. Now this is taken from the book called 7 Powers by Hamilton Helmer. He wrote this: if a company were growing at 10% per year, the next 3 years would account only about 15% of its value. So what does it mean contributing a small percentage to the long-term growth of the company? If you look at the income percentage each year against the total accumulated income of 1.59 million, the first 3 years constitute to about 6 to 7%. And if you look at the growth aspect of the company, the first 3 years compared to only less than 20% of the total income of the company, which means that even if we have a loss of income for the 1 or 2 years, the latest years which you can see from year 9 or year 10, it constitutes to more than 10% of the income. If you are patient and you let the compounding effect of the stock to grow at 10% or more, the ability that the company can make for its income will be more substantial in the latest years. Number 2, is the company margin positive and growing? Now, why is it important? Because you want to own a company that is profitable, and only with profits can the company be able to survive and you're able to use the money for different purposes like buying back the company's stock, expansion, or even pay off its debt. Now, example like net profit margin to be positive. And a positive net profit margin tells us that the company is currently making money. Now, why are some investors able to stay calm? Because they do not make fast or rash decisions. They're able to understand the business, the quality of the company, and they're able to understand that the company will be able to survive during the downturn. Number 2, they focus on the long term. The bear market could be over in the short term. And number 3, they're prepared that as the price comes down, it's cheaper to buy some of the company at a discounted price, and they recognize this as an opportunity. So if you need help in your portfolio and you're looking at ways to take advantage of market opportunity, check out the link around this video and I will speak to you soon.